Senator Sinema is remote from Arizona.
Thank you, Mr. Chairman. And Chairman Powell, thank you for being here today. In raising interest rates last month by 25 basis points, the FOMC cited Russia's war against Ukraine as a key contributor to elevated global uncertainty. The war has serious implications for global energy and agricultural markets. And as you know, energy inflation in particular can appear in the form of higher prices of other goods and services. This feels like a substantial driver of inflation overall, and in my mind, you can't understand the global economy fully without assessing the range of possible outcomes in Ukraine. As we've also seen, the war created new supply chain problems overnight and has caused abrupt price swings in select committees. How is the FOMC assessing the economic impact of the war and the range of potential outcomes in order to inform how it sets monetary policy?
So the principal, I guess there are two things to say. One is that the principal way that the war has affected our economy is really through commodity prices, grain and particularly energy prices. That's the main thing. I think really, and those have both flattened out. Energy prices globally have settled down and they're at a higher level, and and food prices as well to some extent. So the second thing I would say is that it represents a significant risk. So the war in Ukraine, the outcome is uncertain, developments there are uncertain, and you have to think of it as a source of potential risk to the global economy and to our economy. We don't, and we look at alternative scenarios and things like that. We don't really do it from a geopolitical standpoint, but we do, of course, model scenarios where commodity prices are higher and things that would look like what could happen from Ukraine.
Thank you. At home, Arizona families are struggling to navigate this economy. Higher prices are making it more difficult to afford groceries, gas, rent, and airfare. But on the other hand, rising interest rates are crowding out investment and making it more difficult for first-time homebuyers to buy a home. Inflation has also slowed housing development to a halt in Arizona. And as you know, Chairman, housing is a major economic contributor in my state. It's also clear that more spending comes with trade-offs, and it's why tackling inflation has historically been so difficult, and yet it's more important than ever that we get it under control. There's been much debate about a soft landing, where we get inflation under control without triggering recession, versus a hard landing, where inflation comes down but triggers a painful recession. Some economists are currently saying they see no landing right now, that growth is actually accelerating, and that more aggressive actions will be needed to get inflation under control. If true, that would be problematic. What do you think about that assessment?
Well, as I mentioned earlier, I think if you look at the data that's been coming in since earlier this year, you have seen stronger labor market conditions, higher inflation, stronger consumer spending, and also we saw some of the low inflation readings from the fourth quarter of last year revised away. If you take all of those, they may be to some extent related to things like seasonal adjustments or a warm January, but nonetheless, they all point in the same direction, and they do suggest that the possibility that that ultimately would need to raise rates higher than had been expected. Of course, we have 2 or 3 more very important data releases to analyze before the time of the FOMC meeting. Those are going to be very important in the assessment we have of this relatively recent data. We'll be looking carefully at that, and all of that will go into making the decision, which we have not made, but making the decision that we'll make about what to do at the March meeting.
Well, thank you. On February 23rd, the Fed, the FDIC, and the OCC released another joint statement on crypto assets and liquidity risks posed to banking organizations. It's clear that regulators see undue risk for banks in the current environment and are taking a more conservative approach. Do you believe these risks are inherent to crypto assets and how they behave, or are some of the risks a product of the current regulatory and policy landscape for crypto assets in the U.S.?
So we're seeing, really, in the last close to a year now, we've seen just a remarkable set of events in the crypto space. Lots of companies collapsing. We've seen massive fraud. We've seen all kinds of things. I think we have to be open to the idea that somewhere in there is technology that can be featured in productive innovation that makes people's lives better. However, in the near term, we see in crypto activity lots of things that suggest that regulated financial institutions should be quite cautious And that's in doing things in the crypto space. And that's what we've issued 3 or 4 releases to the banks, along with the OCC and the FDIC, the Fed has. And they essentially say, you really need to be careful here. You need to be careful. It's early days with crypto. There isn't the appropriate regulation. We're learning lots about the risks, and they are many of the same risks that run in other parts of the financial system, but without appropriate regulation.
Thank you, Senator Powell.
Thank you.
Thank you, Senator Sinema.